Welcome to Remarkable Retail Podcast, Season 6, Episode 5, presented by Marketile. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, Steve, the content just keeps coming from the NRF Big Show in New York. We just released a bonus episode last Friday with Roshan Juntra, General Manager of Retail for Square. And for this episode, we assembled an outstanding panel of thought leaders to talk about the latest in technology, innovation in retail stores. We have Chris Todd from Theatro, Daniel Black from Glass Media, both of which I think are from your backyard in Dallas, and Morgan Davis from the other side of the nation with Marketile.
Well, first of all, I really wanted to do an episode that is focused on leveraging technology in stores. Turns out, physical retail, not dead.
Not dead.
I know people are shocked for me to say that. But we do know that in general, traffic is even harder to come by. And so that, to me, means one of the things you absolutely need to do, therefore, is to maximize the traffic that you get. So that means improving conversion rates, cross-sell, upsell, creating that really remarkable experience that customers will want to talk about and keeps them coming back. And there's a lot of activity going on. And so these are a few people from within our network in particular, as you mentioned. I know Chris and Daniel from the venture capital retail tech scene in Dallas. And I think they each bring a little bit different perspective in terms of the innovation, what it brings for customers and how they approach it. So good conversation.
Yeah, it's a great conversation. Now, you lead this conversation. I'm the producer. We have 4 microphones and we had 4 guests, not 5. So I was in the background just making sure the sound was great. So thanks for leading the conversation. You did an amazing job.
Thanks. It's also a little bit of payback from longtime listeners will know that I managed not to make it to one of our interviews and you went solo. So now the universe is balanced.
Yes.
And everything is in alignment going forward. And with any luck, it'll be both of us as we move ahead.
And I also wanted to do a shout out to our listeners. We really appreciate you and thanks for listening and sharing. And if you have any suggestions on big themes or issues you'd like us to tackle on the show, be sure and reach out to us on LinkedIn or whatever. We'd love to hear from you. All right, Steve, let's jump into the news. I guess the first big story of the week that we should probably cover is Bed Bath & Beyond gets tossed a lifeline. So what do you make of this? This Hudson's Bay Capital, which is, by the way, for the listeners curious, has nothing to do with Hudson's Bay. The retail seems like a bunch of pretty sharp finance folks have thrown them a big lifeline. So what do you make of that?
Well, of course, as soon as I predicted on last week's episode that they would file for Chapter 11, this happens. So I did not see this coming. I definitely was hearing that there were no traditional lenders, equity players that were going to step up. But these guys, hedge funds, stepped up for $1 billion-ish in equity and debt. From what I can tell, basically, I mean, the filing and perhaps liquidation of the company was imminent. And this allows them to buy some time. It's kind of a crazy deal as far as I can tell. Like, I don't really understand how, other than buying Bed Bath & Beyond some time, this is very likely to work out. The business is in serious trouble. They announced they're closing another 150 stores. It's very unclear what the plan is that's really going to right this ship.
How do they get out of all these stores without going into protection, by the way? Like,
well, they don't.
They don't, right? I mean, there's still money there. They don't just walk away.
I mean, as far as I can tell, unless there just coincidentally happen to be a bunch of leases coming up, they're on the hook for these leases. Now, they may be able to work their way out of some of these over time, but they can close the stores, but they're still going to pay, presumably, they're going to pay rent on these for quite some time unless they eventually
and a penalty, no doubt.
File.
Could be a penalty there too, right?
Many, as you know, many have operating covenants. And so, from a cash flow standpoint, I assume it improves it somewhat, but it is not the panacea that perhaps, getting out of liabilities that perhaps a bankruptcy filing could happen. But it does buy them some time. One of the things that's also kind of crazy about the whole thing is that over the last few weeks, Bed Bath & Beyond became one of these so-called meme stocks. And if folks aren't familiar with this, it's basically a bunch of people that have no idea how stocks work that get excited in certain equities, and they become really popular. And this sent Bed Bath & Beyond stock up a lot going back 2-3 weeks. And
Is that the play here from Hudson's Bay Capital? Is buy it for $1 and sell it for $1.05 and get it out? Is that the play
in
here?
Theory, if you could get the stock to go up a lot and stay there, you could raise additional equity and close the debt out. AMC, which was another meme stock, went through kind of this roller coaster ride up and actually issued some new equity to take advantage of it. Turns out the stock has come down from there. So it's a very volatile play.
Kind of relies on the bigger fool theory of finance, right?
Exactly, right. So could it work out for them in the relatively short term? Perhaps. But in the meantime, it certainly seems like Bed Bath & Beyond is likely to blow through a lot of cash and is very likely to find themselves in crisis in the not too distant future. So I was surprised for sure. I don't think this does anything strategically to change the outlook. It just kicks the can down the road a bit.
Let's talk about a few more earnings. Capri released earnings, which were kind of disappointing. And I never heard of the name Capri, but I certainly know the brands underneath the umbrella. Talk about that a bit.
Yeah, they got renamed. They're a holding company. It was originally basically Michael Kors Inc. So Capri now is comprised of Kors, Jimmy Choo, and Versace. And we're kind of early in the earnings season. We're getting the companies that end on the calendar year. Most of the retail earnings are going to be coming in the first week of March. So brace yourself. But this was, big company, kind of accessible luxury focus. Their sales were down 6%. They gave pretty weak guidance. And the stock has really gotten clobbered. And I expect anybody in kind of this accessible luxury space is going to have some challenges because the customer is not necessarily the uber wealthy person that, kind of can go through any cycle and is not particularly price sensitive. And they sell a lot of products that nobody really needs. So I think this will be an interesting kind of subsector to look at. And then we also got a couple other big companies' earnings this week. Under Armour actually beat Wall Street's expectations, had a bit of an improvement in terms of what's been a few rough quarters for them. But they sounded kind of an optimistic tone, which was a little bit surprising because their inventory, we've been talking about inventory gluts for a while now. Their inventory was still up 50% year over year on more or less flat sales, and their margins took a big hit. So the fact that they were a little bit more optimistic was good for the stock. They've got a new CEO who comes from outside the industry, comes from Marriott. So we'll see what happens there. But they were definitely sounding a more positive tone. And then the other one I wanted to mention quickly was Simon Property Group. So they're one of the big mall operators, and tend to have higher end malls. The interesting thing, and their performance in the mall part of the business was solid, not amazing. But they did call out that they were having some struggles in the part of their business, which includes some retail investments. So they got into a partnership with Brookfield on JCPenney. They also own the Spark Group, part of the Authentic Brands Group, and the Real Rue Gilt Group, which is the flash sales group. And performance there profits fell 33%.
Forever 21, they also have something to do with Forever 21?
Yeah, Forever 21 is, I think is within the Authentic Brands Group.
Okay.
It's a little complicated.
CEOs,
because
I think, in that one, right? I think
there's some overlapping ownership and joint ventures, and it's kind of confusing. But they really got into at least the JCPenney and the Forever 21 part, mainly because both of those brands looked like they were in serious trouble, and they were big tenants, of course, of the big mall operators, and it seems like they bought into those investments to kind of talking about buying time here today on the podcast, but buying some time to get through COVID and kind of work their way forward. But in terms of operating performance, they're definitely weighing them down.
And we'll actually get a good perspective on overall shopping malls and big real estate. We just got off mic with an interview with Tom McGee from ICSC, and that'll be in a couple of weeks, but a great interview with some great insights. All right, let's get to some quick hits. Layoffs. It's funny. I this common percentage number, I remember this great book, Sherlock Holmes book, The 7% Solution. It seems like the 3 or 6% solution because everybody seems to be finding the right number, and more names outside of retail, but around retail are starting to do some layoffs as well,
Yeah, I don't know if this is a little bit of the canary in the coal mine. As we know, and we've talked about a bunch, the job market still looks really strong, particularly in the U.S.
Sure.
And a lot of the press has been around tech layoffs. In fact, some more got announced this past week. But now we're starting to see more layoffs outside of tech, some pretty big names. A bunch of retailers like Saks have announced layoffs. Disney just did a big I think 7%. I think the number you quoted, layoff.
Yeah.
Affirm, buy now, pay later, just did a big layoff. And what I'm wondering really here is whether there's kind of a cascading effect. In other words, if everybody's doing it, does it either make you feel like you can get away with doing it and not take the heat, or if you don't do it, you're going to look bad to your board, or is everybody else seeing things that perhaps you aren't seeing yet? So I can imagine there's a little bit of a domino effect that could start to happen across the next few weeks and the next few months. And then, of course, depending on upon the mix, it's one thing to say that the job market is robust, but that's not necessarily true for everybody in their particular skill set.
Right.
So it doesn't necessarily mean that folks are going to be able to find, most folks are going to be able to find a job in a matter of days or weeks or what have you. And then as more people get laid off, maybe it takes them longer to find a job. Maybe the job that they can get doesn't pay as well. A lot of the tech jobs, the wages were really inflated. And so the dampening effect this could have on consumer spending further down the road, I think might be more significant. But again, as we've talked about, there's really kind of conflicting forces going on here.
So during the COVID era, we saw a great rise in savings rate. So we're starting to see some numbers here that savings rate, in one way it's kind of worrisome. And in the other way, it's kind of getting back to historical patterns. How do you see it? What are the numbers you're looking at, and what's your perspective?
I think it's unclear, other than the trend is that consumers on average are starting to eat into the significant savings that they've compiled. And a lot of folks are starting to comment on this. But yeah, we are getting back, or we're getting away from what was kind of crazily high savings rates to things that are much more common. So I think if it starts to flatten out here, that's not necessarily a cause for concern. But given interest rates going up, given spending slowing, that could make it more problematic. I generally think as long as the job picture remains strong, it's not a big worry. But as we just talked about, that picture could change.
Yeah, and there's a qualitative nature to that picture, right? Restaurants and food service hiring is picking up, but you're not going to go from coding the metaverse to working in the bus line in a restaurant, right? So that's your point about the nature of those jobs.
Yeah, exactly.
Who was it? NRF put out an announcement about February imports expect to be lowest in 3 years. But is that, again, it's kind of like perspective. Is that meaning something important, or is that just because they were so crazy high because of COVID buying forward patterns from consumers? What do you think about that?
I think if you look at the long-term trend, it's objectively or just on its own, it's a low number. What's hard to parse out is, on the one hand, we know, as we talked about earlier, there's been an inventory glut. So retailers looking to get their inventories back in line, one of the ways to do that is to buy less stuff, right? You can sell it, or you can buy less stuff. And generally speaking, it's a combination of the two. So I think this is to be expected to a certain degree, just in terms of the inventory rebalancing. Whether it's also a sign of pessimism on the part of retailers, is probably some of that as well.
Canada Goose has dialed up its growth plans. Now, they I know the company fairly well, of course, because it's got the word Canada in it. And a couple of things I see them doing, they're expanding their product lines, but then they say they want to grow their store network. Now, they've been a bit soft with the challenges in the Chinese economy, which was growth, but I think they're thinking that growth and margin are behind their ideas. What do you think of their plans?
Well, Canada Goose, to me, I mentioned them in my book there and sometimes in my keynotes. To me, they're really a remarkable retailer. They've got a very clear focus on who their customer is. They deliver something really remarkable and are very disciplined as far as I can tell. And yes, they've had some issues because of being very reliant on the Chinese market, which has obviously been an issue for many people. But that seems to be an improving situation for them. And I think they really feel like they can step on the gas, both in terms of, like you say, product expansion, expanding some distribution through wholesale. But I think the big move is the direct-to-consumer push, their own stores. And so they're looking to get to $3 billion Canadian over the next, I think, 5 years, and to double their store footprint. So I think that'll take them from 50-something stores to about 110. So once again, turns out physical stores may not be dead.
I guess we should have said about Canada Goose and their Chinese plans that they're floating a balloon up to see how that message goes. Should we have said that?
A trial balloon?
A trial balloon?
Spy? Yeah.
A spy balloon? Well, whatever's going on
there. Too soon. Anyway, we wish Canada Goose luck. All right, without further ado, let's hear now from our store panel, recorded live at the NRF show in New York City.
So we're here from the floor of NRF to talk about in-store innovation, and we've got 3 great CEOs and founders to help us do this. So welcome, guys. We'll go very quickly just to have each of you introduce who you are, maybe just a bit about your personal and professional journey and what you currently do. So, Chris from Theatro, do you want to start out?
Glad to be here. Appreciate the opportunity to chat with everybody and so forth. So, Chris Todd, I'm CEO and one of the co-founders of Theatro, based out of Dallas. Go Cowboys after a big win last night, so got to put in a plug for the Cowboys.
By the time this airs, though, we could all be very disappointed,
so
be careful.
Out, I guess, exactly. Yeah. So, we make, Theatro is an innovator in in-store technology for connecting the frontline workers to their company to allow them to communicate and bring their culture to life.
All right, and how long has the company been around?
We are entering our 11th year.
Wow.
So, yeah.
Right. So we're the OG on the panel today. All right. Well, thanks, Chris. Daniel Black, another Dallas guy.
Another
Tell
Dallas
us about
guy.
You
indeed.
and Glass Media.
Yeah, I founded Glass Media. I guess I'm the founder and CEO. We're based in Dallas, like Theatro as well. Started in 2015, so we're a little over 8 years old, and we specialize in custom digital signage, bespoke visual solutions, and interactive retail experiences.
All right, that sounds very cool, but we're going to have to figure out more about exactly what that means.
Yeah, we sure will.
And Morgan?
Yeah, happy to be here, not from Dallas, from Salt Lake City, co-founder, CEO of a company called Market Dial. We're here to show, and there's hundreds, thousands, vendors here all promising ROI on their different solutions, offerings, and whatever. Our job is to help retailers sort through that and run experiments to figure out which ones actually drive value for their business and which ones aren't worth investing in.
Right. Excellent. So we start kind of big picture. Turns out the death of physical retail was a little bit exaggerated, and today we're really focusing on what goes on in a physical store, how you help retailers increase conversion or cross-sell, upsell, whatever, and figure out what's working, those kinds of things. But I'd just be curious from your perspective as you guys have been, you launched your business, been running your business. Daniel, what do you think people get wrong about physical stores or the potential of physical stores that kind of perpetuated this narrative of the retail apocalypse and other kinds of things?
Yeah, sure. I think people tend to forget how intellectually curious a lot of consumers are. As we make advancements in technology, we make advancements in corporate sustainability, so sourcing materials. I think people forget how impactful storytelling is and how much the consumers yearn for that knowledge.
Right.
And I think there's no better place to get that than in a physical environment where you can either engage with a retail associate or you can touch and feel the product on your own.
How about you, Chris? What's your perspective on that?
Absolutely. I think that, just if you think about why is it that you go into a store, it's actually the human-to-human contact, right? What does a consumer want? Good eye-to-eye contact and easy, fast, knowledgeable associates to answer their questions.
Right.
They also want to touch and feel the product, and that's things you really can't do in an online world. And there's an efficiency of online, but you lose that human touch.
Yeah, they haven't. As much as things have advanced, there's certain things that the online's just not been able to come close to replicating. So Morgan, you got a little bit different angle on this. What's your take on the importance of physical retail?
Very similar stuff I've heard from you, which is retail is dying in a way, but it's bad retail that's dying in that those retailers who aren't innovating and offering new and interesting experiences to their consumers are dying and closing stores at historic paces still, and will continue to do so. And a lot of what people get wrong is that some of these efficiencies are exciting online, and maybe I can ship some shoes to that consumer really quick and deliver that value. But all of the D2C brands recently are sort of finding that that's not enough, and we need to come offline and have a harmonious concept between the two. And it's not just replicating allbirds.com in a physical store. It's figuring out what that consumer wants at that moment here. And that is a lot harder than people expect, I think.
Yeah.
But figuring that out and innovating and pushing those bounds is really how the magic of retail and sort of that harmonized experience can happen.
Yeah, well, thanks for using my term. I appreciate to get
I'm a big fan.
Small royalty fee.
When I was going to say, Steve, another thing too that's interesting is the challenge now is online chatbots. You can do your standard FAQs, right? But we need to train all these retail associates to be able to speak to kind of the complexity and the history of the products and the merchandise. And that's going to be a big challenge, right? Because you can't get that online. You need to go to the store, but you need to ensure that retail associate can talk the talk, right? And walk the
Yeah, we
walk.
talk a lot about, and we've done even an episode on, what I call the difference between buying and shopping. It's sort of like, or errands versus experience. And, online's pretty good if you want the shortest distance to getting a particular task off your to-do list or whatever. But as you start to get into those more complex questions, or just wanting to, see product in real life, try it on, does it fit, put an outfit together, all those kinds of things are, really haven't figured out how to do that particularly well online. So let's go a little bit deeper. So Morgan, when you, what problem is it that Market Dial solves for retailers, or what opportunities does it create? Give us a little bit more sense of the business model and how it works.
It's a great question. So the problem in retail is a good problem to have, which is there's lots of folks out here like all of us with different unique offerings. Every team in retail is designed to come up with new hypotheses. The pricing team, the merchandising team, the labor team, they're all trying to push the business forward in their sphere of influence, and they have these ideas. The scientific method doesn't end at hypothesis, though. It ends when we can accept or reject the results of an experiment here. And so our job in there is to help make that part of the scientific method quick, easy, replicatable, so that that pricing analyst, the merchandising analyst, the labor analyst can run experiments in their store in a cheap, small-scale way to understand what's going to work and what's not.
Right.
Empirically, from the thousands of experiments that have been run using our platform, about a third not only don't work, but actually erode margin and units and transactions, all of the bad sort of KPIs. And so if you run 100 new initiatives and you don't know which 30 are destroying your value, you're toast, because you're going to put those into your fleet and dilute the customer experience, dilute your margin and experience that you're giving as well. So our part in there is how do we make that experimentation process so easy and low cost, and anybody can do it in the org, that they do it every time and they have full visibility on ROI before they commit to that new end cap or that new space move or the pricing structure or whatever they're thinking about.
So what's this? Because when I first heard about Market Dial, I thought, well, I've been involved, as probably plenty of people listening, of saying, we're going to pilot or test, and we pick, X number of stores for whatever reason. Mix of North and South, we like the store manager, they do a good job, whatever. And then we'll just look at how those stores perform versus everybody else. Testing, really simple test and control. And then, if sales are up in these stores 10% and the others are up 7%, it's successful, right?
Yeah.
That, to me, has been it's not very sophisticated.
No,
but you're doing obviously more than that.
You'd be surprised by how few people even get that far, honestly, especially brands that come from a strong founder that are very brand driven, that maybe have few SKUs and products. It just kind of works, right? So for a long time, brands like great customers of ours like Vineyard Vines, they put something out in the world and it just works, right? Like people buy it as much as they can, it sells out. And so the thought of optimization and how to maximize that is really secondary, because it just kind of works regardless of what you do. And it's not until that's not the case that comps aren't just easily up and to the right that you really have to start thinking about doing that. And so that is the base case. These middle sort of cases where we're going to put our sort of finger in the wind are a form of experimentation, inaccurate and not super scientific, but they are something. And so it points you sort of in the right direction. But for me, if I was making a tens of thousands, millions, hundreds of millions, sometimes dollar commitment to a big CapEx or OpEx change, I don't want a good feeling about it, right? Like the data
warm
needs
and
to support
fuzzy
it. Exactly, that's just not enough for this. And those are the scales that we're talking about here, right? Like if you have 1,000 stores and you make a $100,000 change in each of those stores, that adds up, and labor adds up, and pricing changes are risky, and so. Getting to a more scientific level is there. If you sort of leave the retail world and think, how excited would I be to ingest drugs that were tested the same way that we test these things? Not, right? Like, I don't know, we gave it to a couple people and they seemed okay,
right.
Let's ship it.
Right.
And obviously one are lives at stake, and one of them is a good experience, but we're all committed to this and dedicated to the craft, so let's do good. Let's do a good job.
Yeah, excellent. Thank you. All right, Chris, how about what do you guys do? What problems do you solve? What opportunities do you create?
You know, Steve, the way I would describe it is, how many times have you gone into a retail store to look for an associate to ask a simple question? And you search until you find somebody and you ask that question, and they say, boy, I'd love to help you, but I'm not from that department.
Yeah.
You ever had that problem?
Oh, yeah.
We solved that problem right there.
Yeah.
Well, the reality is that associate you're talking to actually is not connected to anybody else, and your chances of finding the right person is a function of how many departments or how many product sets they actually have, right? Because not everybody can answer every question.
Right.
And so the idea of like what Theatro does is we connect everybody together, everybody's reachable, and for the first time, everybody's accountable.
Yeah.
Because too many associates, too many team members are actually just on the floor, they're in the store, they don't know what the plan of the day is, they don't know what their operation is, and if you can actually allow them to actually understand what their role is, understand what they're supposed to do on a day-to-day basis, ask questions and connect to their peer group, execution goes up. So in retail today, physical retail, a lot of it's about change management.
Sure.
Well, you know, if you think about it, when you go into a store, how do you find somebody? You walk around and look for them?
Yeah.
How does management find somebody?
Yeah.
They walk around and look for them.
Yeah.
They know where they're assigned. They really don't know where they are. How do you even know where somebody is all the time? If you have complex plans, you have different operations, you want to introduce curbside, you want to introduce these, different experiences.
Yeah.
How do you do that if you can't communicate together? And that's actually the basis, Theatro.
Right.
People ask, where'd you get the name?
Yeah.
Think about it. The store team members are cast members in a theatrical production.
Yeah.
You could not do a theatrical production if everybody doesn't play their role and doesn't in synchrony amongst everybody else.
Right.
And at the end of the day, it's pretty simple what we saw. We build those workflows that pull off all the different complex experiences you're seeing in stores.
With respect, when I first heard about Theatro at the beginning, I thought, well, they're just selling a bunch of walkie-talkies or something. What's innovative about that? Obviously, it's much more than that. But what's sort of the secret sauce on top of? Because originally I thought, I guess, more of a kind of a hardware solution, not the intelligence that's propelling it.
It's a great point, because some people do think of us as a hardware, because I built a little IoT device and I provide it to our customers as part of our service. And the reason is because only 30% of retail workers actually have a computer, a mobile computer to use while at work.
Yeah.
So 70% don't, but of that 70%, 50 or half of them have a two-way radio. Okay, two-way radio. So we replaced the two-way radio with a very intelligent IP device.
Yeah.
Kind of like analogy would be, think about Nest. Is Nest just a thermostat? It replaced the thermostat with an IP device that actually Google's building all kinds of cool stuff on top of.
Right.
We're the same thing. We replaced the radio. I'm not a radio. It's one. I have 140 different apps.
Yeah.
One of them is the radio app.
Yeah.
Right.
Yeah.
But that was the entry point. Get in there, replace the radio. I could give the radio away for free. It doesn't matter.
Sure.
Low value.
Yeah.
But that's where people tend to think of it as like a starting point. Most of the stuff we do is you can much more complex interaction workflows and so forth.
Yeah. All right, Daniel, your turn. And now you have such a visual aspect that we'll have to get people to go check out your website so they can picture it a little bit better.
Sure.
But what is it that you do for retailers, and how's that evolved?
Yeah, so Morgan spoke a bit about experimentation. Digital signage for quite a long time, over a decade, has just been a set it and forget it, right? People throw up TVs, they build video walls. The big problem with that is we mainly work with visual merchandisers and store designers who really care about the store experience. And the problem with digital signage is they haven't been able to repurpose it, right, or make it their own. And so what we do is, we have a huge production facility in Dallas. We actually make custom digital, and all of our solutions are modular. So we give visual merchandisers the ability to test something in window and bring it in store, and actually, be able to better empower themselves to utilize technology to draw customers, draw eyeballs, and ultimately sell more product. And I think that's what digital signage has been missing for the last decade. It's really been run through IT. It's just been a set it and forget it, and none of the people inside the store have had any impact on what it looks like and where it's placed.
Sure. So a bit of a jump ball question here. When you think about the challenges retailers have, which are many, right? Driving store traffic, converting, cross-sell, upsell, trying to get high net promoter scores so people come back, and the literally customers remark on the brand. When you go into, and any of you guys want to start, but when you go into a retailer and you're trying to talk about these higher order dynamics that you help drive, are there any commonalities? Are there any things that you feel retailers don't appreciate as opportunities?
I think from our perspective, especially when I go into a store, physical retail store, we look at things through the eyes of execution, because you can have amazing strategy that headquarters does. It can have an amazing ROI, but when it gets down to did it fail because it wasn't well executed, or was it a bad strategy?
Right. Sure.
And execution is where it all falls. Where the rubber meets the road.
Right.
And so we look at the store. I don't necessarily see the merchandising, the positioning, the branding, and all that. We look at the team as a way to say, all right, if all that comes together, it's all got to come together at the end of the day. Did that person who's interfacing with the customer, right, deal with them the way they wanted to be dealt with?
Yeah. And when you are successful with retailers, obviously you've been successful with quite a large number of them over the years, is the thing that makes them expand with you or stick with you that you show higher conversion rates, you show higher average cross-sell satisfaction? Like, what are the metrics, I guess, that retailers are using to evaluate whether your stuff works or not?
There's really 4 things that you can do. We can either increase sales by speed of service, right, faster, reduce abandonment, which then drives net promoter scores, NPS scores, happier customers. Employee engagement, so lower turnover because employees are engaged, or productivity. So I can do any of those, and so with our customers, it's which is the highest priority. And if you look at the difference between somebody like a Macy's versus somebody like a Costco or a Walgreens or a Wawa, a C-store to a department store, you have different objectives. Some are trying to drive revenue, some are trying to do this. And that's really, it's a matter of how you orient and motivate and get their store team to execute. What is the goal? What's the plan? What are you trying to hit?
That makes sense.
Actually, we had a really interesting set of experiments around that one of our customers ran, where they coupled new technology in their stores explicitly for execution, sort of management, tracking, all that kind of stuff, with a little bit of a pay increase as well, because we were asking a little bit more, and so they combo those things together. And they wanted to see what was the outcome. Did we get better execution? Well, they did, a few points higher in their tracking measurement. But the interesting thing is they actually saw a big enough basket size increase to pay for both of those things. They didn't believe it at first because you pay more money, you add some technology, your basket size increases, and they're like, I don't know. So we actually ran it 2 more times, so 3 times in total, in different test cells and controls, and they experimented the heck out of this thing. Execution and having that done well and having that experience really adds to that feeling. Gretchen from Container Store just yesterday here at the show was saying how when you walk into a Container Store, it's a feeling that's there, and that's what you're going for. And with shoddy execution and with sort of haphazard things put together, the feeling's not there no matter what.
Sure.
So, really, I was shocked that it was that valuable.
Totally agree.
Yeah.
Totally agree.
You have a perspective on that, Daniel? And then I have a follow-up question for you that's related to what Morgan just said.
Yeah, I think just in terms of modularity of digital signage, just empowering the stores to look at tests, right? A/B tests with digital signage to drive incremental footfall, drive sales lift. Like I said, a video wall at the cash wrap is not something you can do a lot of A/B testing with.
Right.
We're even doing things like on the countertops for promoting loyalty programs or gift cards. That's all stuff we can track in the point of sale,
Right.
Web online.
Yeah.
And so I think that's the future of digital signage is rapid A/B testing and tying that with visual digital storytelling.
Sure, but my follow-on question, because we're talking about feeling, there's the branding aspect of things that happen in stores, right, which are more intangible.
Sure.
And one of the things I think is so impressive about what you guys do is it just, to me, it just elevates the environment, right?
Absolutely.
It's part of the visual package, but then there are those specific things where there's a call to action, essentially, that you can measure. Is that something that your customers struggle to measure the impact or not so much?
They struggle to measure, and then, you look at trends, shop in shops, right? So we're not just looking at a department store. Now it's a store within a store, and what's that emotional connection when you get to that aisle of whether it's a watch, it's sunglasses.
Right.
So everyone is trying to kind of hone in on that emotional connection.
Yeah.
And I think, honestly, we're seeing a lot of results, but like Morgan was saying, some of it's hard to measure. Some of it's all qualitative.
Right.
It looks pretty, but is it driving sales?
Right.
And we need to connect both those dots.
Yeah, when I was at Neiman Marcus, every store would have several $100,000 in artwork. What is the ROI on that? And why couldn't it be half as much or, whatever? And it's very hard to say, but it's part of the brand image and the sense that it works.
There's a sense that there's a corollary that gets down to even in the communications aspect. So, for instance, when we connect everybody together, if I send you a message and say, Steve, you want to have lunch tomorrow? Versus if I send a message to you and say, we have a recall, please take this off the shelf.
Yeah.
It's the same technology, it's the same everything.
Right.
The value of one message, orders of magnitude greater than the other. How do you put an ROI in that?
Right, yeah.
How do you say, okay, the first one,
right.
We're doing 10,000 messages a month.
Right.
Okay. Some of them are really high value, and some of them are, hey, thanks for helping me with that. Low value. How do you do that?
Yeah.
It's like the artwork. There's a lot of gray area.
Sure, and I think the balance. I think what's nice is, I guess I feel that retail has always been, a balance of art and science.
Yeah.
Now there's a lot more technology and, to be able to bring more and more science to it, which, I guess I'd like to think that narrows the areas where the intuition or that magic happens, but you still need that. Clearly, there's lots of retailers that are not super analytically driven that do quite well.
It narrows it, but makes it more important because that's your way to sort of bring that feeling and life to it.
Yeah.
Like when I go into a Dick's Sporting Goods, you can't see me on the podcast. I'm not known for my athletic prowess. I'm an athlete. Okay,
Yeah.
when I go into Dick's Sporting Goods, and there's more there than just pure raw science. Now, science helps get us to that right point, but there's this good combo that makes me feel like an athlete in Dick's Sporting Goods.
Yeah, absolutely. So try to bring this home, and you can kind of take this any direction here. We'll give you a little bit of latitude, but sort of last words for each of you. What's next for you, or what are you most excited about in the industry or for your company in particular? So, Daniel, want to start on that?
I think for us, we're getting more into the analytics. So we're doing a lot more in lift and learn. Mm-hmm. So you're actually touching the products. We're measuring that engagement. So I think for us, connecting more sensors, doing things with gesture, where we can track people's hands, we can track their eyeballs. I think that's really the future to real-time or rapid A/B testing in kind of what we do in digital signage.
Interesting. I didn't realize you guys were doing that. That's cool. Morgan?
Yeah, one thing we're doing that I'm pretty excited about is a lot of our customers and buyers and kind of users of our platform and software are the retailers themselves. So, Dick's Sporting Goods, Container Store, Woolworths, great folks doing this. They have a lot of partners that they actually work with, though, the brands who supply their goods in all these cases. And they're driving innovation in those stores. They're asking for different space. They're trying for new sets, their new products. So we're working with them to try to build a sort of three-sided marketplace, or something, if you will, to bring those brands closer to those, so we can all have the same data and decisioning tools to say, did it work? Did it not work? How can we tweak it? and retry this new initiative that this brand is pushing. So how can we not just do retailer to market dial? How can we bring those brands partners in as well and have a more holistic view on the outcomes?
Yeah, nice.
What we're working on from an innovation standpoint, Steve, is almost every one of our customers has their own roadmap of what they'd like to accomplish.
Yeah.
Theatro, I'm super proud of the fact that just this month we were recognized by RAS as the number one technology innovation, number one software technology innovation company by tier one retailers for the third year in a row.
Wow.
Nobody's ever won it twice.
That might even be remarkable.
Yeah, it is. But the reason that actually the tier ones keep voting Theatro, we're obviously not a well-known brand compared to a Microsoft or an SAP or a Salesforce, is the fact that we innovate and do just about whatever they want to do, solve real problems. And so that's kind of on our next step, is actually taking those. We have 420,000 customers. Mm-hmm. They just work at 40 different brands.
Yeah. Right.
It's always been our tagline is innovation for the forgotten hourly worker. Not many people build stuff for hourly workers.
Right.
They just assume they're going to execute their strategy, their plan.
Yeah.
We're all about that. And so super proud and super excited about what the next year is going to bring for physical retail.
Yeah. Well, I think it's going to be, this to me is a good example. Aside from just, being a little bit flip about, turns out physical retail isn't dead, but, you just think about, whether it's how hard it is to get traffic in the first place, so making the most of that from a branding and a conversion and a, just dollars and cents standpoint, leveraging sales associates, with the labor challenges is, hugely important. So I like to think that there's maybe this new appreciation for physical retail and the various possibilities that technology and other things can provide. Well, thanks so much, guys, for joining us, and we wish you best of luck for 2023. And
Absolutely.
We'll see you out in the world.
Likewise.
Thank you.
If you like what you heard, please follow us on Apple, Spotify, your favorite podcast platform, so you can catch up with all our great interviews, including Organized for Growth, our interview with Satish Mahatra, CEO of The Container Store. New episodes of Season 6 presented for another season by our friends at Marketile will show up each and every Tuesday. And be sure and tell all your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker and producer, and host of a series of retail trade podcasts, including this one. You can learn even more about me on LinkedIn, and you can catch up with Steve and I in person at Shop Talk in Vegas, March 26th, and a month later in Barcelona at the World Retail Congress, April 25th. Until then, safe travels, everyone.